Today, I will go through 3 red flags that are showing us that we are about to go into one of the biggest, if not the biggest market crash in history. I'm not a financial advisor, and the information I'm sharing with you is from my own research and my own opinions on how I see the market and the economy will be in the next couple of months and years. So you can take all the information that I'm giving you with a pinch of salt and then do your own research. So let's go straight into it. Red flag number 1, the stock market versus the GDP. As of September, the total market cap of the US stock market is approximately about $55 trillion. To use simpler terms so that everybody understands what I'm saying is, as of September 2024, the total value of the companies in the US stock market combined altogether in total is about $55 trillion US dollars compared to the $47 trillion this time last year. This number includes the value of all the stocks traded on big exchanges like the New York Stock Exchange and the Nasdaq, as an example. So if you add up the price of every stock in the US, it will equal this huge amount of $55 trillion. Are you with me? At the same time, we have to look into the US GDP. So the US GDP stands at today approximately at $28 trillion, comparing to last year's figures when it was about $27 trillion. So let me explain it in more simpler terms so that you understand exactly what we're talking about here today. The US GDP, or gross domestic product, is like a report card for the country's economy. It measures the total value of everything produced, and this has been calculated over a specific period of time. So let's say, for example, that we're just taking into consideration of this year, 2024. It's like a report card for the country's economy. It measures the total value of everything produced, or their goods and services within the United States over a specific period of time, usually calculated each quarter or each year. GDP tells us how much money the entire country have made from producing or selling things like cars, food, and even services like healthcare or education. So if GDP is growing, it means that the economy is doing well and making more money. But the opposite terms, if the GDP is shrinking, it means that the economy is struggling. So let's summarize these numbers from 2023 to 2024. The stock market is up $8 trillion. The GDP is only up $0.1 trillion. You do the math yourself. So why is it important to understand the total market cap of the US stock market and the US GDP? What's the connection between these two factors? Let me explain that to you. Now, the relationship between the total market cap and the GDP tells us if the stock market is in line with the real economy. So if the US stock market cap is way higher than the GDP, it could mean that the stock price are too high compared to what the economy is actually producing. Make sense? So this might be a sign that the market is overheated or overvalued and could be at risk of a crash. On the other hand, if the market cap is closer to or lower than the GDP, it might suggest that the stock price are more in line with the actual economy or even undervalued. In short, understanding both helps people figure out if the stock market is reflecting the real economic situation or if it's out of sync, which can help them to make better decisions about investing or understanding the economic risk. So here's the consequences. History tells us such periods have often led to market corrections or even big crashes, as seen in the dot-com bubble in the late 90s and the financial crisis that we saw 2008. So let's have a look how the market and the economy looked like before these big crashes, just to have something to compare with. We're gonna start off with the dot-com bubble in the late 90s and the early 2000s. Now, during the peak of the dot-com bubble in March 2000, the total value of the US stock market was approximately about $17.6 trillion. That was a huge number back then. It was much higher than what was normal for the economy at that time. At the same time, the US economy, the GDP, was about $9.9 trillion. So the stock market was worth almost twice as much as the entire US economy was producing goods and services. And if I break it down in more simpler terms, the stock market was overvalued compared to the actual size of the US economy. And it was mainly because of the hype around the internet and the tech companies. Just before the deadly people, that was us back in the days, realized that many of these companies weren't going to make as much money as they thought or even survive in the next couple of years. What happened then? The whole bubble burst and the market crashed down to its feet. But this time we'll stay ahead with our eyes and ears open. We learn from our mistake. You don't judge a person by the mistake that they've done, but how they react after they've done the mistake. So here's a bit more information in relation to the financial crisis which we went through 2008. So just before the financial crisis hit 2007, the stock market was worth about $20 trillion. And the US GDP at that time was about 14.5 trillion. So breaking that down to you again, the stock market was still worth more than the US economy. But the only difference this time was that the gap wasn't as big as it were during the dot-com bubble. However, the crisis wasn't about overhyped stocks. It was the problems within the housing market and the banking system. So when those problems became too big to handle, the stock market crashed and the economy went into a deep recession. So here's some fun fact. The dot-com crash actually began 2 months before the final rate hit, and that happened in May 2000, bringing down the federal funds rate to 6.5%. That was when the market started to go down. And the market nearly began its decline almost immediately after the peak in March 2000. The Nasdaq lost more than 75% of its value from the peak by October 2002. Going back to the financial crisis, moving forward a couple of years to the financial crisis 2007. The Fed last rate hike before the crisis was in June 2006, when it last raised the federal fund rate to 5.25%. This time the market started to crash approximately about 16 months from the last time the Federal Reserve took up the interest rate. And that took 21 months until the market reached its bottom. Now, the average duration of time for the market to decline in these two recessions have been an average of 2 years. The dot-com bubble took longer to fully play out, 2.5 years, compared to the financial crisis, the housing crisis that we went through, took about 1.5 years, but both were severe and had a lasting impact on the whole economy and on the investors. So they say history repeats itself quite a lot, if not, it rhymes. So here's my thoughts and my prediction this time. So history shows that the crash started 2 to 16 months after the last time the Federal Reserve raised the interest rate. In other words, interest hikes. So the last time the Federal Reserve increased the interest rate was back in 2023 on the 26th of June. They increased the interest rate from 5.25% to 5.5%. This was the part of the Fed's ongoing efforts to fight inflation by tightening the monetary policy. 5.25 comparing to the 5.5, these numbers look quite similar. So my prediction is that we should see the crash starting from now until the 26th of November. It can be sooner and it can be later, as I can't see into the future. That's only my own prediction, because history has a tendency to repeat itself, and it has for many, many years.